All right, guys, welcome back to another edition of the Emerald Financial Group podcast, the EFG Podcast. It's good to be back, Tim.
It sure is. Thank you very much, Sam.
Yep, and I see that we've coordinated our outfits roughly today. So, yeah, God, we must be on the same page.
We'll soon find out.
We will soon find out, that's for sure. Before we begin, look, if you enjoy our content, or even if you don't, consider leaving a comment, consider clicking the like button, consider subscribing. It'd really help us out a lot, and it's absolutely free. So,
If you've got any suggestions on content that you like to hear or a subject that you'd like us to talk about, slip that into the message below as well.
All right, Tim. So today we're going to talk about house prices and really how they've been the major driver of Australian household wealth for the past 30 years, the chief investment of the Australian family for the past 30 years. They haven't made us the lucky country, but they've ensured we've remained the lucky country. And the dramatic rise in household prices has basically pushed up to an equivalently dramatic effect the wealth of everyday Australians.
Yeah, well, that's right. And now the question is that all about to change? And, should investors start looking at the real estate property a little bit differently and also start looking at different asset classes?
Yeah, absolutely. So I think we'll, perhaps dive into some statistics, some information. We'll bring up our first chart, and let's take a bit of a look at that one.
Let's get into it.
So this is a chart of real or inflation-adjusted residential property values for Australia since the 70s. And you can really see that even when accounting for inflation, house prices have gone up quite dramatically. Now, the one thing I kind of wanted to point out was that it's actually only really the late 90s, however, that prices really started to accelerate. And this is the sort of period that I'm talking about here. Before that, there really wasn't that much inflation-adjusted growth. So if we actually look at these periods here, apart from a small bit of growth in the late 80s, most of the sort of mid-70s to late 80s and then most of the 90s was actually fairly sideways movement when you consider the effects of inflation for Australian house prices.
Absolutely. Quite interesting to look at it from this perspective, because when you talk to a lot of people, they talk to the fact that, house prices have gone up heaps over, a huge amount over the last 50, 60 years plus, but they don't really hone into the different periods and showing that sideways period versus the massive growth period we've seen since the 90s.
Yep, absolutely they don't. So I think, it is when people say, well, housing always goes up and, it's a sure bet and prices keep rising. Well, it is worth noting that in Australia's history, there have definitely been periods of sideways movement. Mm-hmm. And it actually, in fact, if you go back before the 70s, it's not that easy to get data on it. But I've seen an analyses suggesting that before the 70s, there wasn't really any house price growth in Australia. Yep. So that is worth keeping in mind. How relevant are those times to the current times? Not exactly, but I think there is a bit of relevance about these flat periods here in the 80s and 90s, and I think the relevance is due to the high inflation that was around during those periods. So I'll just bring up another chart, and we can basically, this is an analogue of Australian interest rates, and the same chart, which is the blue line, which is the house prices, the interest rates being the red line. And during the sideways movement of the sort of 70s, 80s, and 90s, we had really, really high interest rates. And that was due to high inflation. And, it's my belief that it's really that as those interest rates came from, very, very high absolute levels down to very, very low levels from the mid-90s onwards, is when we had, that equivalent massive rise in house prices. And you can really see that on this chart, I believe. As the sort of interest rates have fallen, the house prices have pushed back up. So that's fantastic for Australian homeowners during that time, Tim.
Absolutely.
And prices have been very, very good for those few decades. But the problem for me is that those interest rates have now hit zero. Yes, you may be able to go a little bit below zero, but the sort of significant drops in interest rates, I think, have largely happened, and we may be starting to see a bit of a push up.
Well, yeah, it definitely begs the question, have we found the top of the housing market for a period of time, right? And I'm not sitting here saying that the housing market's not going to go up in value at all, but I'm just sort of saying for a period of time here, especially now we're starting to see interest rates go back up again. We've got an inflation problem that the central banks are trying to fight. What's to come from house prices? And, we're hearing on a daily basis at the moment that house prices are coming down. Sellers are struggling to sell, and there's a bit more downward pressure, which is not really being seen on the chart here because it's a bit more longer term. But it definitely raises the question, doesn't it?
Yeah, absolutely. And, unlike in the sort of, I guess, mid-2000s, Australians are much more indebted than they were, last time interest rates got to, 2-3%, potentially up to 4%, some people think. And we can see that on this chart. Basically, house prices as a ratio of income are at their highest ever level. And again, that's due to the extremely low interest rates. And then household debt as a proportion of incomes are also at record levels. And again, due to extremely low interest rates. The problem is that unlike the sort of mid-2000s, we're much more leveraged into housing.
Yes.
Where we're sort of a lot more indebted, and our sort of ratio of income to the asset value is a lot lower. Sorry.
Yeah, and that's all well and good when interest rates are, variable rates are sitting at 2.7%. But when you start lifting those rates dramatically, like what we've seen this year, well, it has a much larger effect than what it ever has before.
Yep, absolutely. So interest rate sensitivity should be much higher now. It's not like 2007 when, I think the central banks were lifting rates into the GFC. We're almost twice as indebted now, and our asset values are significantly higher.
Yep.
I think exactly as you say, it's much more sensitive to those movements.
Yep. I've got that highlighted on that end PowerPoint as well. We'll go across that in a bit more detail in a moment.
Well, so this is something I did want to bring up, but perhaps we will come back to this one and move on to what you wanted to bring up here, Tim.
Yeah. So as we were just talking, this highlights. So we talk a lot in percentage points and indexes and stuff like that. So let's just put some real dollar value on this. And I've grabbed the median house price since 2000 through to 2016. And you can see back in 2000, the median house price was about 280,000. And then fast forward to 2016, that jumped to 1.2 million. Right, so if you owned a property over that period of time, you're looking at something like a 329% return, which is pretty crazy stuff, right? But the main point of this slide here is we've just seen the RBA lift rates from near zero to 1.85%. They're likely to keep going, right? Now, I've used my own case example here that's happened. So, my variable rate back in March before the interest rate hike started was sitting at 2.7%. Now the current variable rate from CBA is 5.5%. So that's a huge increase, right? Close to doubling of the interest rate. Now, back in 2000, if I owned a property, or 2001, I should say, if I owned a property, that would mean my interest would be going from $8,000 up to $17,000, an increase of $9,000. Look, it's not great. It's an extra $10,000 a year, right? That's a huge amount of money. But it's nothing compared to what people are facing right now. So if you were to buy a house at the median price right now of 1.2 million, it's not an increase of $10,000 a year. It's an increase of $33,000. That's insane amount of interest, right? Now, I get, you can definitely pick apart my numbers there. This is just a quick, vague example because, if the median price is 1.2, your loan's probably going to be more like $1 million because they're not going to lend you the full 1.2 and the rest of it. But it still demonstrates the huge increase of interest that you're now paying. It's 3 times the amount than what it was back in 2000.
Yeah.
Now, I know my wage hasn't increased by 3 times, has it?
No, wages have not increased by 300% over that time. In fact, they've dramatically lagged those increases, those house price increases. Yeah.
So we've got to really highlight here, when you're looking at the property market, whether it be for your first home, whether it be for an investment purpose, you've got to start going, okay, well, can this 300% happen again? Or can even a doubling happen again in the next 10 years? Because they say housing doubles every 10 years, roughly, right? So can I really envision, and I'm struggling to see this at the moment, Sam, 10 years from now, will the median house price in Melbourne be 2.4 mil?
Yep. And look, I will struggle to go that far out, but my personal belief is that it certainly won't be. And, I'm happy to put my name to that. I very, very much doubt that. And, going back, I think we're in for a similar period to what we saw in the 80s and 90s in that, you have higher interest rates, you have higher inflation, and as a result, these house prices sort of they fluctuate a bit, and there probably will be some slow gains over time, but not that rapid appreciation that we saw from the late 90s onwards. And the simple fact of it is, we're not going from 10% to 0 interest rates. We're actually going from 0 to, some people believe up to 4% interest rates. And, even if we do drop back to 0, everyone's already leveraged up to the point that we were at when it was 0. So those sort of easy house price gains, and that easy sort of Australian wealth, I think is not going to be as easy moving forward.
Correct. So that sort of raises the question of where do you put the money in? We're not saying that residential is a dead asset, right? It's definitely something to still consider, but you got to be much more smart about it than what you ever were before. I think gone are the days where you just go buy any house and it's going to go up by double in 10 years. You're going to have to be super selective about what suburb, what area, the actual house itself, what type of rental return you can gain, and really do your math and know what you're doing to pick the right property in the right area that will gain in value over that time.
Yeah, absolutely. Fantastically said. There will be houses in Melbourne that will double in value.
Absolutely.
In the next 10 years. But just looking at the average, I think that's unlikely. And I do sort of want to highlight that, a report that BlackRock put out, they're actually quoting some US researchers that their belief is we're seeing an end to what they call the great moderation. We're seeing an end to the low interest rate, low inflation, stable growth, low volatility period that's existed since 1985, they defined it as. And in that environment, everything went up, shares went up, property went up, everyone got rich. And if we're not in that period, what's going to replace it? Yep. Well, their belief is a period of higher volatility, a period of greater fluctuation, and a more volatile period. Now, that doesn't mean that prices won't go up. It doesn't mean prices won't go down. It doesn't mean some people won't get rich. Doesn't mean anything like that. But it might mean that you have to be a bit more selective. You have to plan a bit better. You have to be a bit more, educated or a bit more selective in your approach.
Yeah, and also what asset can you play the volatility in? So in the housing market, it's extremely hard to play volatility because, it just costs so much to transact, doesn't it, right? So I'll go back to my PowerPoint here. You can see the stamp duty comparison back to the median house price in 2001. The stamp duty was only costing you $10,000 but now it's costing you $66,000. Now, that can equate to a big chunk of your profitability, okay? So that's whether stamp duty obviously charged when you buy, but if you're selling, you're going to cop the whole real estate agent fees and things like that as well. So, it's not cheap to transact in the property market. It's also not cheap to maintain a property.
No.
Okay, there's a lot of overheads that you got to think about. Everybody argues the whole negative gearing side of it. Well, I'd much prefer a positive geared asset anytime over a negative geared one. Negative gearing is great when you've got a lot of, you're rich and you've got a lot of income, right?
Yeah, and as long as prices keep going up.
And prices keep going up, correct. Now, when prices don't keep going up, what's the point of negative gearing, guys? You got to think about that. So then you got to compare that back to the stock market. And if you want to change back to that slide, Sam, about XJO versus the property market, I think you just got to go up one. There you go. Right. So this chart here that Sam's prepared has got the XJO overlaid to the property index. Back over what time frame have we got there?
Since 1992.
1992, right? So you can see that the XJO, and that's not including dividends, by the way. That's just the index by itself. But equally, the house price index doesn't include rental income and things like that, right? So we're not talking costs here. This is pure price increase. You can see the XJO has, outperformed the property market over that period of time, although in a much more volatile way.
Yep, absolutely.
Right. So pros and cons, right? So housing market, it's good for your anxiety, right? You can buy, back in the day, you could just buy, sit and wait, and it tends to go up in value most of the time. It doesn't have the volatile swings. Where with trading the stock market, there's a little bit more volatility and angst against that, right? So there's a lot of psychology behind the stock market, and I guess there's a lot of negative a lot of people out there that talk very negatively towards the stock market in Australia.
Absolutely.
And it's probably because they've come in, had a bit of a play, haven't gotten educated, haven't done it in the right way, lost a little bit of money and want to go out there and spruik to everybody the stock market's horrible and the rest of it. Where in fact that a well-timed investment in the stock market can very much outperform the property market.
Yep. And I wanted to add to that. I think that the average Australian is done a massive disservice by the news media and the financial news media here in Australia.
Yep.
If you go onto the AFR, if you go onto even more mainstream, The Age, Sydney Morning Herald, Herald Sun, you watch the ABC or Channel 7, Channel 9, they'll be telling you that late last year, with markets at all-time highs, how good everything is and how it's a great time to buy and jump in and buy up shares. And then similarly, 2 months ago at the middle of June, they'll be telling you how it's a terrible time to buy and how things are all falling apart and how bad it all is. And yet, if you'd listened to them, you would have bought at the absolute peak and you'd be selling at the absolute bottom. So no wonder a lot of people sort of come in and poo-poo that, because they get fed this garbage narrative from the mainstream media, and it really does them a massive disservice. Now, not to spruik our own selves too badly, but go back and listen to what we were sort of talking about 1.5, 2 months ago.
Yep.
And there's more nuance to the debate. There's a lot more nuance to stock markets than simply what the latest bit of economic data is. And markets are forward-looking. Often bad data is priced in because markets are on the side of caution. And by the time, as they say, by the time a recession hits, markets have typically bottomed out in advance of that.
Mm-hmm. Mm-hmm. And looking back to the mainstream media point, guys, I honestly, when they get really negative is the time to start buying usually, right?
Yep.
So that sort of marks the bottom. Same as marking tops, Bitcoin topped out just a little bit after the mainstream media started pushing the whole crypto space. It was within a couple of months that Bitcoin hit 80,000 or 75,000 or something like that. and that was it. You know, so once the mainstream media get a hold of something, you know it's either close to the top or the bottom, right? But yeah, so flicking back, so look, we're not saying that property is not an asset to leave alone. Like, property is definitely just some well placed funds into property is always good. Okay, but I think now you've got to be so much more selective than you ever were before, and that also goes for the stock market. But the difference here is volatility is good for trading and investing. Okay, it's horrible when the market just goes up and up and up and up forever because you keep going, oh, should I be buying? It's so high already. Should I be buying? It's so high already. Where when you've got frequent pullbacks, you know when you're buying. Okay, you buy at the bottom of those pullbacks. Now, how do you pick the bottom, guys? Well, we've got a great video on YouTube on that as well. We use a lot of technical analysis techniques to help us do that, and we're always happy to miss a little bit of the bottom just so we can get confirmation. So there's plenty of techniques out there that most people aren't aware of. The average Joe doesn't get taught this in high school. You've got to go out and get educated. So just as much as I believe property is great to go invest in, you now need to go get educated. Gone are the days where you can just go buy one property, get a bit of equity, buy another, and you're going to be safe, right? It's not going to be the case anymore. Interest rates are going up. Property prices might come down a bit, go a bit sideways for maybe 2, 3, 4, 5 years more, who knows? So you now have to play it smart in property. Same thing goes as the stock market, but my opinion is there's going to be so much more opportunity in the stock market to come than what there will be in property.
Yep, absolutely. All this, as sort of BlackRock and their researchers are suggesting, we're moving into a more volatile period. Well, what's the one big advantage of volatility? There's distortions. There's good prices. Things can overcorrect one way or another. And, by becoming educated, by having a bit of knowledge, sometimes we can take advantage of that. Again, if you regularly watch our content, we think there's probably a bit of downside distortion in some of the commodities stocks.
Absolutely.
Particularly, a lot of the base metals that are going to be important in the future. And I think there was a bit of an example of that last week with the BHP offer for Oz Minerals. Oz Minerals trading around $18, $19. BHP sees the chance to snap up a bargain, offers them $25. Well, unless you sort of had that sort of forward view, you might not have seen the bargain at $18.
Yeah, that's right.
So, look, that's one of the great things about the volatility. One of the great things about the stock market is it is liquid. You can transact quickly. We can get in and out, and we're not paying that $66,000+ stamp duty fee when we do so.
So what's the comparison here, right? So $66,000 there in stamp duty, right? But if you want to buy $1.2 million worth of stock, you're looking at about $1,200.
Yep. So 0.12%. We'll be charging online brokerage rates around that level very, very soon. So if you do want to open a trading account with us, our rates will be very, very attractive. I'll put a link in the description below.
Yeah, the big thing here, guy, I'll just repeat myself again because I'm just going to have to really harbour on this point that the stock market does require a level of timing. Okay, get educated. Go learn a bit about technical analysis. That's number one. It's the easiest thing you can learn on the market, okay? And that's the most effective in the sense of timing. So, go learn some technical analysis, guys. There's plenty of courses out there, including our own. Don't want to plug our product too much on our podcast, but, it's so important. Doesn't matter what asset class you're going to invest or trade in. You've got to get educated now. You've got to see where the value is. Gone are the days where you can just go out and buy some, growth stock that's borrowing a bunch of money, trying to make a go of it. Those growth stocks aren't going to be the same as what they were in the last 5 to 10 years, guys. Interest rates are going up, which means people are going to move back towards value, and they're going to be looking for value in stocks. Okay?
Absolutely.
So you want positive earnings. You want decent price to earnings ratios.
Yep, absolutely. And look, get educated. I think we'll put a link for our free miniature course in the description below as well.
Yep.
So that's a great starting point. No cost to you guys, and learn what it's all about.
Yep. So I think that's all I've got, Sam.
That's pretty much all I've got to say as well. Hopefully everyone enjoyed this one. If you did, let us know. If you didn't, let us know. And we'll move from there.
Absolutely. Take care. Bye for now.
Thanks, guys. Bye.